This is from the desk of Stephen Feldman, CEO of Hard Assets Alliance, Rethinking Safety When Traditional Risk-Free Assets Evolve. Dear valued investors, ever since 2022, I've been writing that the dollar and US Treasuries, the fortress safe haven asset, would be under siege. It was bad enough that at the time the US government credit was deteriorating. At the time the federal debt was $30 trillion and rolling at higher interest rates, which would increase deficits and the debt in a potential doom loop. Now foreign governments needed to be concerned that their assets would be frozen if they were part of the US-dominated global economic monetary system. The gold price was $1,800 per ounce, and we encouraged investors to get ahead of this trade and roll the clock forward to today. And even without the chaotic policies of the current administration, the fiscal picture for the US would be deteriorating. The debt is now up to 36 trillion and growing, and interest on the debt is at a run rate of $1 trillion. But those chaotic policies have already created dangerous risks and consequences. Slowly but surely, US investors are waking up to this fact. But don't rely on me. Just ask Ken Griffin, one of the world's richest men, who is the founder and CEO of Citadel, one of the world's leading multi-asset market makers. In recent comments at the World Economy Summit in Washington, D.C., Griffin expressed grave concerns. He noted that previously no brand compared to U.S. Treasuries, the strength of the U.S. dollar, or the nation's creditworthiness, but recent tactics have eroded that reputation. Griffin didn't mince words, stating that using the euro as a reference, the U.S. has become 20% poorer in 4 weeks, creating an environment that produces no winners or bright spots. Perhaps the most concerning is his observation about international sentiment, questioning how allies like Canada and Europe feel about the United States today versus just 2 months ago. Meanwhile, David Rubenstein, co-founder of Carlyle and another billionaire with keen insight into global markets, points out that Asian governments, once the most reliable buyers of new US government bonds, have gradually lost appetite despite more uptake from the US, UK, and Canada. Recent auctions have seen thinner order books. People have been willing to buy our treasury bills. Rubenstein notes, at some point, people won't be willing to do that. The implications are very serious. A failed treasury auction would reprice trillions of dollars in global securities, devaluing collateral everywhere and forcing margin calls on a scale unseen since 2008. At Wharton Business School, where I was an economics major many moons ago, I learned the capital asset pricing model. It's a very simple and profound model that states, in short, that every asset is priced off the risk-free US Treasury. Is the US Treasury now a risk-free asset? If it is not, doesn't every other asset have to be repriced? And if every asset is repriced, what is anything now worth? And is there a risk-free asset? My vote is that it is gold with no credit or counterparty risk, with deep liquidity and fungible around the world. Is it too late to buy gold now at $3,300 an ounce? Absolutely not. What we're witnessing is the initial stages of a fundamental restructuring of the global monetary system. The trends I've been highlighting for years are accelerating, not abating. Gold remains one of the few assets with no counterparty risk in a world where trusted counterparties are rapidly diminishing. The metal's price appreciation thus far is merely reflecting its reassertion as monetary insurance in uncertain times. Remember, gold isn't just rising against the dollar, it's setting record highs against virtually every fiat currency globally. This isn't a speculative bubble, it's a rational revaluation as market participants increasingly question the sustainability of the current financial system built on unprecedented debt and monetary experimentation. For investors who have followed our guidance over the years, this validation is satisfying but not surprising. For those just waking up to these realities, know that this transition to a new monetary paradigm will not occur overnight. There will be a chance to position yourself accordingly, though perhaps not at the prices available to those who acted earlier. In times of financial uncertainty, seeking shelter in time-tested stores of value isn't speculation, it's prudent risk management. U.S. Gold Bureau alert: investors losing trust in U.S. financial system. Is trust in the U.S. financial system breaking? Lock in gold and silver now. Markets were rattled this week as a rare and unsettling trifecta hit Wall Street. Stocks, bonds, and the dollar all dropped simultaneously, a red flag usually reserved for emerging market chaos, not the world's largest economy. The Dow tumbled nearly 1,000 points on Monday. The US dollar hit a 3-year low. Treasury yields spiked as investors pulled back. The catalyst, President Trump's escalating tariff war and attacks on the Federal Reserve, have spooked investors worldwide. Confidence in the US as the safe haven of global finance is starting to crack, and that has historic consequences. While Trump walked back some Fed threats and hinted at a China deal, briefly boosting market sentiment, the damage may already be done. Foreign investors who hold over $8 trillion in US debt are starting to flinch, and if they start buying, the consequences could be catastrophic. Meanwhile, gold holds the line. Gold, which surged to an all-time high of $3,500 earlier this week, dipped slightly Wednesday, but technical support held strong near 3,292. The pullback is being called a weak connection within a strong uptrend by Saxo Bank, signaling further gains may still be ahead. This pullback may be a window of opportunity with underlying fears about U.S. credibility and global instability still in play. Many see this dip as a chance to accumulate gold before another potential wave of uncertainty sends it higher again. Lock in gold and silver now.